Life insurance policies are one of the key tools that are used in estate planning, and that is because life insurance benefits can be used as a source of income replacement after an individual has passed away. But what happens if the beneficiary you wanted to leave behind with that life insurance policy benefit is not the most financially responsible person? Or maybe you just wanted to have more control over how that person accesses and uses the funds that are the insurance benefit. In that instance, you may want to consider an Irrevocable Life Insurance Trust, also known as an ILIT. With an ILIT, the trust will actually own the life insurance policy, and the trust would be administered, maintained, and funds would be dispersed in accordance with the terms of the trust document, which were created by the individual whose life was insured by the policy. There are some cons to an irrevocable life insurance trust that I really need to stress. First of all, they're irrevocable. And what that means is the person who creates the trust cannot make any changes to the trust once it has been created. Irrevocable means it is gone. You've given away that right. The only people who can actually make changes to an irrevocable life insurance trust are the beneficiaries. So it is very important that you are aware of that as you consider whether an ILIT is the right mechanism for you. But there are also several advantages of an ILIT. As I explained before, it gives the individual a little bit more control and security in knowing how those assets are going to be handled once they've passed away. There's also a tax benefit. If you do not have an ILIT, the life insurance proceeds are actually going to be taxed in the estate tax of the individual whose life was insured by that policy. On the other hand, if you use an ILIT, those assets are pulled out of your estate because you never owned them. They're owned by a trust, not you. Another important benefit is asset protection for the beneficiary. Because the ILIT owned the insurance policy, the ILIT also owns the funds that were paid out by the insurance policy. As a result, if the beneficiary has a lawsuit and they've got creditors who are looking after their assets because they're trying to get whole, they're trying to get payment on that judgment, they cannot look to the assets that are in the ILIT because the beneficiary does not own it. They only have a beneficial interest in the funds that are in the trust. So that's another thing you need to consider when you're thinking about the pros and cons of an ILIT. It is extremely important to note that although the beneficiary doesn't own the ILIT assets, if the beneficiary passes away, the ILIT assets will actually be taxed in the beneficiary's taxable estate. As discussed, there are pros and cons with using an ILIT. Use the link below to schedule an estate planning consultation so that we can weigh the pros and cons of using an ILIT in your estate planning.